The phenomenon that will be identified and explained is that movie theatres offer different and often cheaper prices during the week, in particular on Tuesday as opposed to the weekends. We will investigate the model of price discrimination and its limitations and its potential drawbacks to society. We will then discuss price discrimination as it pertains to our particular case study of cheap Tuesday tickets for cinemas. Finally, we will examine how it affects our society as a whole and whether it increases social and economic well-being. The graph shown depicts the change in revenue for cinemas in the US on each day of the week using data from 2016. It is evident that revenue is lesser during the week than it is on weekends, and that is through price discrimination the cinema can maximise profit despite the lower revenue earned during the week. Price discrimination is a tool which involves charging customers different prices for the same product or service. Price discrimination is most effective when the profit made by separating markets is greater than profit made by maintaining a combined market. This depends on the relative elasticities of demand within the submarkets. Consumers within a relatively inelastic submarket receive higher prices, and consumers within a relatively elastic submarket receive lower prices. First-degree discrimination is also known as perfect price discrimination, and it occurs when a business charges each individual the maximum price they are willing to pay for each unit. Second-degree price discrimination uses the quantity consumed as their criteria for altering the price of their product or service. Third degree occurs when the price charged varies for different consumer groups. Demographic data is used in calculating the optimal price for a given group, and this price is given exclusively to members of the group. An example of this is that customers at movie theatres are separated into groups, child, adult, senior, based on age. Each group is then charged a different price for the same movie ticket. Third degree price discrimination is the most common of the three. For price discrimination to be implemented, the market that the company operates within must have imperfect competition, meaning it must be able to choose prices with a downward sloping demand curve. The market also needs to be able to be separated and able to stop resale. As such, it retains a higher overall level of competition within the market. The price discrimination model holds several disadvantages. As it maximises profits from a firm, it could lead to a decline in consumer surplus, as the maximisation of profit means that the highest possible price is always being offered. The use of the model can also cause extra administration costs when separating the different markets, which would mean that the total surplus is less than it would be if only the equilibrium price was used, introducing a deadweight loss. The model can also have ethical concerns, with price discrimination being able to finance predatory pricing, which leads to a decrease in producer surplus and can create a monopolistic market. It can also be damaging to welfare, as it does not take into consideration the individual, but only the demographic. The ultimate goal of movie theatres, like any business, is profit maximisation. Price discrimination is deemed most effective when the profit secured from separating the market segments is greater than treating each of the market segments as one. Within a submarket of inelastic demand, the value of prices does not affect consumption of the product or service. The buying behaviour of consumers, however, within a submarket characterised by elastic demand are affected by a change in price. As such, businesses that decrease the prices for consumers and customers, such as the movie theatre, belong to the submarket with a relatively elastic demand. Customers can enjoy the same movie at lower prices on a Tuesday. However, the typical customer on a Tuesday will possess different characteristics from the moviegoer on, say, a Friday or Saturday night. With the lowering of price on Tuesday, owners of the movies appeal to a wider range of consumers. The phenomenon outlined is a case of third-degree price discrimination, as varying prices are issued to the two market segments differentiated by their socio-economic status. To satisfy price discrimination, the phenomenon needs to satisfy three criteria. Firstly, movie theatres function in imperfect conditions. Secondly, they have protocols in place that prohibit the resale of their tickets. And finally, the two submarkets have varying elasticities of demand. Within the inelastic submarket graph, change in prices is shown to have little effect on the demand within the higher socioeconomic submarket. Profit is depicted by the area MC, P, X, and Y for the inelastic submarket of customers within higher socioeconomic status, and the area MC1, P1, X1, Y1 for the elastic submarket of customers with low socioeconomic status. The profit is evidently much less for the elastic submarket comparative to the profit accrued by the movie theatres within the inelastic submarket. With the rise of the internet, movies are easily accessible, and by utilising the tool of price discrimination, movie theatres have the opportunity to increase their revenue and break even with the hopeful outcome of making a profit. A single price is issued per submarket, and a firm looking to make the greatest profit will determine this as the price when marginal revenue equals marginal cost. However, as marginal revenue is lower than price, allocative inefficiency exists within third-degree price discrimination. When the demand curves are linear and the costs incurred are constant as illustrated in the above diagrams, profit maximizing level of output is redistributed among the consumers. This implies that the deadweight loss, the difference between consumers' marginal willingness to pay for an extra unit of good and marginal cost of producing that extra unit, is still present by the same amount. This causes a welfare cost to arise, with the distribution of the good from consumers willing to pay a higher price to consumers who are willing to pay at a lower price. Therefore, it is suggested that ultimately third-degree price discrimination presents a less efficient scenario than when it is not implemented. The tool of price discrimination leads to an indefinite loss of efficiency, with marginal benefit and marginal revenue of various consumers, which indicates the presence of uncaptured gains from trade. In this sense, price discrimination can be a bit of a gamble, but it will serve to maximise and benefit individual firms with market power, like movie theatres. However, whether it will benefit society as a whole with improved economic welfare and efficiency, it is not guaranteed every time.